Hi everyone, let's go over my low time frame and micro bullish and bearish Elliott Wave scenarios on Bitcoin. Starting with my low time frame bearish scenario, where we are looking at a three-wave structure before continuation to the downside. This three-wave structure is then either a WXY, where all of the waves are three-wave structures, and in this wave Y we are then looking for a zigzag structure, or we are looking for an ABC, where then the final move to the upside is a five-wave move. Now the most common target for wave Y has already been hit between the 1 and the 1.236, taken from the low to the high of W to the low of wave X, and the most common target for wave C is above over here between the two 1.618s, which is between 30.5k and 30.9k. Now if this is the high of wave Y, it is very short in time compared to W as well as X, so that kind of lowers the probabilities a little bit of this being a wave Y. And what I think is very interesting still is just below wave C, the target area, we have the triple top at 30.4k, and there must be some interesting liquidity resting above these highs. However, what is the probability of this high being taken? Because for a wave C, we're then counting a five-wave structure to the upside, currently in a 4. You want to see this high being taken. So let's jump into the micro scenarios and then have a look at the probabilities locally. The first scenario I want to show you over here is the main micro bearish scenario, where we are simply looking for an impulsive structure to the downside, where this is then a wave 1 followed by a corrective wave 2, and then we're looking for a 3 to the downside. Most common target area for a wave 2 is between the 0.5 and the 0.786, pulled from the high to the low of wave 1, and as you can see, none of these fibs have been hit so far, and the 382 is a rare target for a wave 2. So we do expect a little bit more upside to at least preferably these targets over here, and then observe the reaction in this area. The invalidation for this scenario is price taking the high at 30.222, because you expect a continuation to the downside, and a wave 2 is not allowed to go above the origin of wave 1. Now, two scenarios on the micro that I have seen but are not really that likely in my opinion are the two diagonals, either a diagonal where you have a 1 2 3 4 5, or we're looking for a double 1 2. Now if we look at these scenarios, I like to stick on the 15, then in this scenario we're looking for a diagonal with a 1 2 3 wave 4 and expecting another 5 to the downside for at least this low to be taken. However, there's a couple of things that lower the probabilities for a diagonal over here. First of all, wave 2 in a diagonal retraced to the 382, as you can see, but the common targets for a wave 2 are the golden pocket to the 786 area, which is far above. So this is a very rare target for wave 2, and actually it didn't even hit the 382, as you can see, with the 382 being taken from the high to the low of 1. Then wave 3, the targets for a wave 3 are over here, with most commonly the 786 to the 886, trend-based fib extension from the high to the low of 1 to the high of wave 2, and as you can see over here, this low is not even coming close to even the rare target for wave 3. Then you have this wave 4, which retraced very, very deep all the way to the 786, taken from the high of 2 to the low of 3, which is a rare target for a wave 4 in a diagonal. And also wave 4 is longer in time compared to 2, which isn't that nice. Usually in a diagonal you like to see all of the waves being shorter in time, and this wave 4 is much longer in time, because the vertical line on the chart is a fib time comparing the time it took to develop wave 2 with the time it took to develop this wave 4. So you can see this wave 4 is much longer, because if wave 2 or wave 4 wanted to be shorter, it had to end over here. Now then finally, you would expect a 5 to the downside, but you can also see that the structure of this diagonal is pretty much a channel, if not expanding, which is a very rare structure when we talk about diagonals. Now the second potential over here is a potential 1 2 1 2 before then continuation to the downside, invalidation being taking the high of this wave 2 over here. In this scenario, you preferably want to see the lower degree count being shorter in time and price compared to the higher degree count. Now the higher degree count is the blue count over here. We have a wave 1, we have a wave 2, and then we expect a blue wave 3 to the downside, and inside the blue wave 3 you then want to see a 1 2 3 4 5. So the white count is a lower degree count. If we think about a double 1 2 or even a triple 1 2 diagonal, what you prefer to see is a 1 2 then a 1, 2, and then a third 1, 2, where you get a contracting diagonal type of structure where each of the wave 1s is taking the low of the previous wave 1 and each wave 2 is shorter both in time and price compared to the higher degree wave 2. However, this wave 2 is much longer in time compared to the higher degree wave 2, which is not really something that you like to see. If we then go to the bullish scenario, then in this scenario we are still looking for price to move towards the upside. The invalidation for this scenario is far below over here the 0.5, as usually in a wave 4 you do not want to see candles closing below the 0.5. Now if I zoom out, this is the whole structure. We are then looking for a 1, 2, 3, 4 and still looking for a wave 5 to the upside, where if we look at this move over here, preferably wave 4 is in with this bounce. Now, as you just heard, I said preferably you do not see candles closing below the 0.5, and I can see you looking at this candle over here. However, in a more bullish scenario, this is then the low of 4. This is a wave 1, wave 2. We had some bullish CVD divergences for then continuation to the upside. So the fact that candles close below the 0.5 is not invalidating a wave 4. And also in the update section in the silver membership, I mentioned that this could be a 1, 2 for continuation. I want this low to be taken to lower the probabilities of this being a wave 4. As long as this low is standing, wave 4 for me is still on the cards. Now, if we then zoom in to how this could be a wave 4, because then that means we are looking for a 3-wave structure in this section over here. I like to open this particular scenario where we are then looking for a WXY. In wave W, we're then looking for a zigzag. Wave X can be any corrective structure. And in wave Y, we are then looking for an expanding flat where wave B over here and then an A, B, C. Wave B retraced to the most common target area for wave B, and wave C ended very nicely right around the most common target area for wave C, which is between the two 1.618s, creating then a WXY correction in then a wave 4 for then potentially that continuation to the upside in a wave 5. So this 3-wave correction over here in wave 4 is then completing this wave 4 over here for then a move up. Has to be said that this retracement over here is very deep. The 886 is a rare target for a wave 2 if this is a wave 1, 2 and continuation. The 886 is more a common target for a wave B or a wave X, so more for corrective structure. So we continue, of course, to have a look at how this structure is developing and if we see any signs of potentially a move to the downside. The only thing I would potentially allow is to swing failure this low, but then preferably again close above the 0.5. And what I think is interesting as well is the rule of alternation. That is that if wave 2 is very shallow and long in time, wave 4 tends to be deep and short in time. And this is definitely a deep wave 4. Going to the 0.5, it's also shorter in time than wave 2. So it fits very nicely with the rule of alternation in Elliott waves. If we then look towards the upside, the main target area for wave 5 is between the 1.236 and the 1.618, taken from the high of 3 to the low of 4, which is between 30.3k and 30.5k, which also has a very nice confluence with the blue target area that I have over here, which includes the triple top, but also some other confluences that you can see over here. A couple of point of controls, also some Fibonacci targets with the golden pocket being here from the high to the low. So it's an interesting area for sure. And then if price can manage to go up here, we have to observe again the reaction to decide if we can expect continuation or if we can expect a move to the downside. Because if we zoom out once again and we go to the low time frame, then if we look for a bullish continuation, so this is basically the low and we now want to see further upside, then preferably price has to go through this zone to at least the 31k resistance area. Then we have to observe the price over here, see how it reacts to this resistance. Based on this reaction, we can then expect potentially continuation or a move down, but at least price has to go through this purple area over here. Now, if we then quickly look at the confluences that we have very, very locally, besides, of course, the target boxes that are on the chart, then you can see that just above the wick that price created over here, we do have a monthly naked point of control and still a weekly, which is not tapped as price returned just before. And over here, price finding support on the daily. If we look at these CVD divergences, well, the bigger ones played out. This was the target, so I removed it from my chart. And if we now zoom in to what's been happening locally, you can see that there was quite a bit of bearish CVD divergences. Also over here, some bearish ones. I don't have them on the chart anymore as they're not relevant. I do think it is at least important to be aware of this over here. We are in bullish market structure with price moving to the upside, and even though we have only like a one candle like order block over here on the 15-minute, when price was moving to the downside, we did see bullish CVD divergences with this candle and the low over here. So then the target would be that high. Now once price bounced towards the upside, we saw over here some bearish CVDs, price moving down, taking this low, played out very nicely as well. Followed up was a bullish CVD divergence for a potential long, moving to the upside, target being this high again. It played out, price took the high very nicely indeed for then neutralizing the bullish CVD divergence. So I can now remove these from the chart. And then the one that are now remaining, or the ones that are remaining, are the bearish CVD divergence between this high and the lower high, or the high over here and the lower high on the chart. Now the question of course now is can this be leading because we also still have the remaining bullish CVD divergences with the high over here, or is this really bearish CVD? That is yet to be seen, of course. If we go to the CVD chart, then you can see over here what I mean. We have a higher low on price over here with this red candle and the low that was made here. You can see also, by the way, the dip to the downside. It's this candle, by the way. So you can see over here, the low of this red candle on the CVD is the pivot that I put my mouse on. And if you look to the right side, the yellow line, it goes below this pivot. So there is some bullish CVD divergence. And in a bullish market structure, that can be enough to make the bearish CVD look like a leading CVD divergence. So price can follow the line towards the upside. Now more locally, going to the 5, then over here, bearish CVD divergence, lower high on price, higher high on the CVD, bearish CVD divergence, price moving down. And then this was actually quite nice. Higher low on price, lower low on the blue line, bullish CVD divergence also played out. And now locally, bit of volatility kicking in just before I started the recording. One could argue it's a bullish CVD divergence with these 5-minute candles, higher low on price, lower low over here on the yellow line. Yeah, we have to observe the 3-minute time frame, because what happens, and this is something I like to at least pay your attention to, is that if we see the bearish CVD divergence on the chart, right, with the high and this these high, lower high on price, but on yellow we have a higher high on the CVD, we can think, okay, it's bearish CVD divergence, price is going to go to the downside. But then always keep an eye on the 1 and the 3-minute CVD divergences. Have a look at what's happening on the 1 minute, have a look at what's happening on the 3-minute, because if you can see on the very low time frames bullish CVD divergences building, then they get a priority over the bigger bearish CVD divergence. Same, of course, the other way around. Now, a summary of everything I've said is written here. I've been mega active this morning in the update section. So over here you can see everything and you can just read through for your understanding. And if I quickly scroll down over here, then I explain the diagonals. That's all good, all nice. But over here, in the end, this is an important part as well, which is a bit of, I guess, trading psychology, because we trade probabilities and no certainties. So what I like to at least say is to keep an eye on the invalidations of the different scenarios, as I write over here as well. Once we now talk about the probabilities, keep an eye on the invalidations of the scenarios. But at the moment, the probabilities based on the micro analysis here are towards the upside. Reason being, over here, that this bearish scenario, well, we still expect a bit more upside over here for a potential wave 2. A diagonal doesn't look good as explained. A 1-2-1-2 also doesn't look good as explained. The bullish one currently looks good, even though price bounced on the 886. So we have to observe the reaction of price in this area, because this area over here will decide a potential bearish scenario or the potential bullish scenario for higher prices. And of course, then the invalidation is taking this high invalidates this bearish impulsive structure. And if we look at the bullish scenario, then if price moves to the downside and hits this invalidation, or at least goes below this wick and closes candles below this wick, well, kind of like the bullish scenario is invalidated. But as it stands now, based on the Elliott Wave probabilities, the higher probability move is for price to at least move to the upside, at least take this high, observe what happens over here, to get more probabilities for up or down, and then potentially moving higher to the upside, because I still think that the triple top over here is very interesting, as well as the confluences, the monthly and the weekly over here. So I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.